We're jumping straight into SanDisk today. Everyone is watching the price action, but the real story is the AI data center surge.
It really is.
You look at the ticker this week, and it's a little messy. The stock's down about 5.74% in a single day.
And it's off its highs by a pretty big margin.
Roughly 18.5% off those recent all-time highs. So if you just glance at that, you might think, okay, the party's over.
Right.
But then you zoom out, it is still up 148% year to date. And get this, 1,500% over the past year.
That's just a staggering number. A rocket ship.
It is, but right now there's this huge conflict playing out. You have this overhang from the Western Digital stake sale pushing the price down.
And that's crashing right into the fundamentals.
Exactly. The explosive fundamentals of AI memory man, which is, pushing the intrinsic value up. It's like the unstoppable force meeting the immovable object.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we unpack the numbers, and believe me, the numbers today are absolutely wild. Just a quick reminder.
Please.
The best way to simplify your market research and really stay ahead of these moves is to subscribe and hit the like button. It helps us, and it definitely helps you keep your finger on the pulse.
It does.
Okay, so let's get into the weeds here. A 1,500% gain in 12 months. That's the kind of number you see on a penny stock that got pumped. Maybe a crypto coin.
Not a legacy hardware manufacturer that's been around for decades.
Yeah.
So what changed? Why are investors piling into a memory company with this level of aggression?
That's the question.
It's definitely not normal behavior, but we're not really in a normal market cycle, are we? We're in the early innings of this AI supercycle.
Right.
And to understand the why, we can't just look at the stock price. We have to look under the hood. They just dropped their fiscal Q2 2026 numbers, and the headline revenue was $3.03 billion.
Which is up 61% year over year.
61%.
Let's just be honest. For a hardware company, that's massive. Usually hardware grows at, the pace of GDP. Right. Maybe a bit faster.
If they're lucky.
Yeah.
61% is software-level growth. That's startup growth.
For sure.
But that headline number isn't even the most interesting part. The real aha moment comes when you look at where that money is coming from.
Yeah.
Because it's not from, USB drives at the checkout counter.
Yo.
The driver here is the data center revenue segment. That segment didn't just grow, it surged 64% sequentially.
Sequentially. Just to clarify, because that word really matters, we mean quarter over quarter, right? Not year over year.
Right. In just 3 months, their data center business grew by nearly 2/3. That's it's unheard of for a company this size.
So this tells us the buyers aren't you and me picking up a memory card for a camera?
Not at all. The buyers are the hyperscalers.
We hear that term all the time. We're talking about the giants here, aren't we?
We are. Amazon, AWS, Microsoft Azure, Google Cloud, Meta. The company is building the massive AI infrastructure that runs, everything.
The backbone of the internet's intelligence.
Exactly. And what people forget is that AI isn't just about the processor. It's not just the NVIDIA chip. That chip is useless without data.
You need massive amounts of storage to feed those chips at lightning speed.
And these hyperscalers are buying SanDisk products hand over fist because they are in an arms race to build out these data centers. They cannot afford a bottleneck in storage.
Okay, so if that was last quarter, what does this mean for the future? Because a 64% jump is great, but Wall Street is cynical. They're always asking, what have you done for me lately?
Is it a one-time sugar rush or is it a trend? That is the big question.
Right.
But if you look at their guidance for Q3, management is effectively telling us we are just getting started. They're projecting revenue to jump, again, to between $4 and $4.8 billion.
Okay, another huge jump.
But here's the number that should make your ears perk up. It's the bottom line. They expect non-GAAP earnings per share, the EPS, to hit between $12 and $14.
Wait, I want to pause on that because the leverage there is wild. Current EPS for the quarter that just ended was, about $6.20?
Correct. $6.20.
So they are guiding for earnings to effectively double in a single quarter, from $6 to 12 or 14.
Double.
That is absolutely insane operating leverage. You see that in a software startup where costs are fixed and every new dollar is pure profit. You don't see that in manufacturing where you have to buy materials and run factories. How is that even possible? It is so rare. And it speaks to the raw pricing power they have right now. It's Econ 101, supply and demand. Demand is just off the charts.
Completely. When demand for high-performance memory outstrips supply, prices don't just go up, they go vertical. Because SanDisk's factories are already built, their fixed costs are covered.
So when they raise the price of a drive by, say, 20%.
Almost all of that extra revenue flows straight to the bottom line. That's why revenue might go up 50%, but earnings can double.
And that brings us to the moat, because I think a lot of people just view memory as a commodity, like wheat or oil. You just buy the cheapest chip that fits, right?
That's the common misconception.
So why is SanDisk winning against Micron or Samsung? Why aren't the hyperscalers just shopping for a better deal?
Because in the AI data center, memory is deeply technical. SanDisk isn't selling generic storage. They've developed proprietary NAND flash technology and these very high-density enterprise SSDs.
High density being the key word. Why does that matter so much?
Think of a data center like Manhattan real estate. It's incredibly expensive to build and maintain. You have limited space.
Right.
If SanDisk can offer a drive that stores twice the data in the same physical slot or uses 20% less power, that is worth millions in operational savings for a company like Meta.
So it's not about the price of the chip, it's about the total cost of ownership of the server.
Exactly. And this leads to what we call switching costs. Once a hyperscaler designs their architecture around SanDisk's specific tech validating its heat profile, its speed, they're effectively locked in.
They can't just swap in a Samsung drive next month to save a few pennies.
No way.
Yeah.
They'd have to revalidate the whole system. That takes time. It risks performance issues. And in an AI arms race, nobody has time for that.
It's like trying to swap the engine in a Formula One car halfway through the race because another one is slightly cheaper. You just don't do it.
That's a perfect analogy. You don't risk the race to save on parts. They've created a sticky ecosystem.
And that protection is vital right now with all the NAND shortages globally. The customers have to prioritize the vendor that's already integrated. They need the chips, and SanDisk is the only one that fits the slot perfectly.
Okay, so the fundamentals are screaming, but we have to talk valuation. Because when a stock is up 1,500% in a year, you assume it's expensive.
You assume the train has left the station. But the numbers, they tell a weirdly different story, don't they?
It is genuinely surprising. The stock is trading at a forward PE price to earnings of, what, around 15.97?
Which is incredibly low.
Yeah.
I mean, the S&P 500 average is around 20 or 22. So this company, growing at 60% and doubling earnings, is cheaper than a boring utility company.
It feels counterintuitive. A company growing this fast would often trade at 40 or 50 times earnings, but the market is discounting it.
It's skeptical, which we'll get to. But if you look at the raw math, the discounted cash flow models, and you have to be careful with these, garbage in, garbage out.
Of course.
But some of those models imply a theoretical value up to $2,006 per share.
$2,000. The stock's at roughly $575 right now. That implies it could nearly quadruple.
Theoretically. The driver is free cash flow. They're projecting $5.09 billion for 2026. But by 2035, the projection ramps up to a massive $21.02 billion.
And when you discount that pile of cash back to today, you get these crazy valuations.
And it seems like Wall Street is starting to wake up. We saw Citigroup make a move recently, right?
We did. Early February, they raised their price target significantly, bumping it up to $750. They see the momentum.
Okay, so that's the bull case. Revenue exploding, a technical moat, and the math says it's cheap. It sounds like a slam dunk.
But, and it's a big but, we have to talk about the elephant in the room. The stock dropped. It's down nearly 20% from the high.
If everything's so perfect, why is it bleeding?
Let's talk about that Western Digital breakup.
Right. This is the overhang we mentioned. It's a classic market plumbing issue. Western Digital was a longtime stakeholder, and they decided to exit. They executed a massive block sale of $3.17 billion.
That is a huge amount of stock hitting the market all at once. That's a flood.
It is, and when you sell that much, you have to offer a deal. They priced it at $545 per share.
Which is a discount to where it was trading, right?
Yeah, a 9.4% discount. So you have a massive seller dumping billions in stock at a markdown. That creates immediate selling pressure. It scares people.
Retail investors see the price drop and think, oh no, does Western Digital know something we don't?
That's the fear response. But there's a flip side to this. I mean, who bought that $3.17 billion worth of stock?
That's the key insight. The deal was oversubscribed. In banking terms, that means there were more big institutional buyers, hedge funds, pension funds lining up to buy those shares at $545 than there were shares available.
So while it hurts the price in the short term, it's actually a signal that the smart money was eager to scoop up shares at that price. They saw a buying opportunity.
So it's a temporary blip. A liquidity event, not a fundamental problem.
Most likely. Once that supply is absorbed, the artificial ceiling on the price is gone.
Okay, so the sale itself might just be a distraction, but there are actual business risks. You mentioned this company has some baggage. It hasn't always been rainbows and 64% growth.
It certainly hasn't. We have to be honest about the history. The memory business is brutal. If you look at their trailing margins over the last 12 months, they were actually negative 11.65%.
Wait, so for the last year, on average, they were losing money for every dollar they brought in?
Essentially, yeah. They were bleeding cash because we were in a trough of the memory cycle. Prices for NAND flash had crashed, there was too much supply, not enough demand, and that leads to the biggest fear for any memory investor, the cycle. The bust cycle. It keeps investors up at night. The market is notoriously cyclical. It goes boom, then it goes bust.
Manufacturers see high prices. They build more factories. They flood the market. And prices crash. Profits vanish. We are in a massive boom right now. The fear is this the peak? If supply catches up to demand, if we get NAND oversupply, prices could crash again. And when memory prices crash, stocks like SanDisk don't just dip, they collapse.
Exactly. And with the stock pulling back 18.5% from that $725 high, it shows the market is already nervous. They're wondering if the valuation is priced for perfection.
Even with a low PE, if earnings get cut in half next year, that cheap stock suddenly becomes very expensive.
If SanDisk misses that earnings target by even a penny, the punishment could be severe. So it's a rocket ship fueled by AI, but it's flying through a meteor shower of cyclical risks.
High reward, high risk. So, for the people listening,
Yeah.
what do we watch? What are the signals in the noise?
There are a few very specific things to watch in the next 30 to 60 days. First, mark your calendars for late April 2026. That's likely when fiscal Q3 earnings will drop.
And we are watching that EPS number like a hawk.
We have to. And management put their reputation on the line with that guidance of $12 to $14. If they hit $10, it's a disaster. The narrative breaks.
What if they hit
The
$15?
stock probably makes a new high. It's that binary. You need to see if the operating leverage they promised actually shows up.
What about outside of earnings? Any catalysts? Now that Western Digital is gone, the company looks different.
It does. SanDisk is now independent. Watch for an announcement of an investor day. Companies do this after a major split to reset the narrative, tell Wall Street, here is who we are now.
And if they announce a strategic roadmap or maybe capital allocation plans like buybacks?
That could be a major catalyst. It tells investors they're confident in their cash flow. And on the macro front, keep an eye on the CapEx plans of NVIDIA and Meta.
Read the transcripts of their earnings calls.
Exactly. If you see headlines that Meta is increasing its AI budget or NVIDIA is selling more data center chips, that's a direct read-through for SanDisk. You can't install a GPU without memory.
Right. There's also this chatter, I've seen it on message boards. Is SanDisk becoming the next NVIDIA of memory?
It's a provocative comparison. NVIDIA owns the compute layer. SanDisk is trying to own the storage layer. It's not a perfect analogy. Storage is more competitive than GPUs.
But the market loves a narrative.
It does. And if investors start believing that SanDisk is the only game in town for high-end AI storage, the multiple expansion could be huge. They stop trading like a commodity company and start trading like a tech monopoly.
And that is a very, very expensive difference.
It's the difference between a PE of 15 and a PE of 40. That's where the multi-bagger potential comes from.
Okay, so let's wrap this up. Massive revenue surge, sticky ecosystem, scary valuation, and the risks of the cycle. Here's a lowdown. SanDisk is in a fascinating spot. The Western Digital exit was painful in the short term, but it cleared the deck. It removed the uncertainty. The overhang is gone. Exactly. And here's a final provocative thought for you to chew on. With Western Digital fully out, SanDisk is now a pure play on AI memory. Does this independence make them a prime target for M&A? Could a bigger tech giant, maybe a hyperscaler, come in and buy them to secure their supply chain?
Or does this independence just make them a volatile rocket ship attached entirely to the whims of the AI hype cycle?
It's a great question. Independence is a double-edged sword. Total freedom, but also total exposure.
And remember, despite the volatility, the average price target from analysts is sitting at roughly $717. From where we are now, around $575. That's about 25% upside. Whether that's enough reward for the risk, well, that's up to you.
Thanks for tuning in to the Easy Money Show.
If you found this helpful, hit that subscribe button so you don't miss the next move. We'll catch you next time.